Hello everyone, thanks for checking out my video. October's first trading week ended with a twist as we saw one of the most unexpected reversals in the stock market last Friday. This turnaround happened despite a flurry of bad news such as rising treasury yields, rising oil prices, and stronger than expected US jobs data. Specifically for Tesla, it showed surprising strength by rising for the week despite missing its delivery numbers and implemented yet another round of price cuts for their vehicles. This reversal and last-minute rally caught some investors and traders off guard. So, with the latest rebound, are the bulls back in play? Is this the start of the seasonal rally? Let's discuss them in this video. Also, I have recorded yet another live option trade that I made last week, so do stay tuned to find out more. Last Friday, the stock market posted a stunning turnaround. It plunged on the stronger than expected job report, and at one point, S&P 500 and Nasdaq dropped by almost 1%. But they then staged a comeback and were up about 1.2% and 1.6% respectively at the end of the day. The S&P 500 ended the week up close to 0.5%, breaking a 4-week negative streak. So what's up with the job report? Well, the US added 336,000 jobs in September, almost twice the number expected. It basically isn't showing the signs of cooling in the labor market that were forecasted, something that the Fed wants to see. So with the job market remain strong, it is actually making a case for further interest rate hike. That's bad news for the stock market. But somehow the market rallied, which left many investors and traders feeling confused. Well, if we dive in deeper into the job report data, we can see that the wages rose less than expected last month. Slower wage growth means lesser money for consumers to spend, which could then bring down inflation. Therefore, that's good news for the market. To add on, the unemployment rate was 3.8% compared to the forecast of 3.7%. This is bad news for employees, but then it's deemed as good news for the stock market and the Federal Reserve. Lastly, bond yields actually retreated towards the end of the week. Therefore, I suspect after the market digested some of this news through the day, money started flowing into the stock market again. This week, all eyes will be on 12 October Thursday's CPI data, and whether last Friday's late rally can continue in the next 2 weeks or so, it may just hinge on this inflation data. A soft inflation reading could be the signal that the rally could continue on this month after the massive sell-off in August and September. Then on Friday the 13th, we have some of the Wall Street's biggest banks reporting their earnings, which include JP Morgan Chase, Wells Fargo, and Citigroup. After this week, it's where earnings season will heat up and things could turn interesting. Meanwhile, according to CME's Fed Watch tool, traders have raised the probability of the rate hike in November to about 27%, up from about 20%. This means the market still has strong expectation that the Fed may pause again in November. But if the Fed were to defy the odds by raising the interest rate, then I think things could turn ugly. So watch this percentage or expectation closely as we enter the next FOMC meeting towards the end of the month. Let's now hop over to the technical analysis segment. So in my last video, I shared that if SPY closes below 426 for about 2 days, there is a high chance that it will continue to head towards that gap at around 419 to 420. And true enough, SPY kissed 420 on a few occasions, just 1 point short of 419. Anyway, if you recall, I also shared that 420 is one of the most important levels that many traders and institutions are watching. And guess what? SPY tested 4 times out of 5 trading days last week and bounced off it. This shows that the market makers don't want it to fall yet. A potential good news is that the MACD is about to have a bullish cross. But before bulls get all too excited, pay attention this week because SPY is currently going for a classic textbook retest of trendline. It basically broke below this uptrend channel and is going back to retest that green dotted trend line. If SPY passes the test, the odds of it going to at least the middle of the channel is quite high in my opinion, which also means that the gap between 435 to 438 will be filled in the process. Not just that, it will also reclaim the 23.6 Fibonacci retracement level at around 439. And just to highlight, that is also where the 50 moving average roughly sits, at 440. But as with all stock movements, don't expect SPY to fly straight to the middle of the channel. Pay attention to how it reacts to those levels that I have earlier mentioned, especially the 50 moving average. Rejection could come anytime at these levels. On the other hand, if SPY gets rejected by the uptrend channel, once again watch for 420, and if we want to give ourselves a bit more buffer, I would say the last important support level is at 417, where the 200 moving average and the 50% of Fibonacci level converges. Okay, this level has to hold. I repeat, it has to hold. If it doesn't, I personally will exit my positions if I have call options. I wouldn't want to fight the bearish trend. Next up, Apple's technical analysis. Apple's chart is looking quite decent as it created higher lows since it hit a low of 167 recently. Not only that, the MACD had a bullish cross last week, and the bullish momentum may continue this week. Note the word may, not will. So what kind of signals or levels should we look out for this week to confirm the bullish momentum? First of all, keep an eye on level 179. This is where the 50 moving average and the 50% Fibonacci level converges. It is kind of a double resistance. If we can put two nice green candles above it, Apple is bullish. The next resistance is at 181. This level is even more important than the earlier one because it is a triple resistance level. It is where the top end of the gap is, where the 100 moving average sits, and where the critical 61.8 Fibonacci level is. Therefore, I would expect some sellers to step in at around 180 to 181 area. And because this is one heavy resistance level, if Apple can break above it, I think we could fly towards the recent high of about close to 190. Before I move on, this channel needs your support. I am about less than 40 subscribers away from the 1000 mark. It may be a small milestone for others, but it is definitely a big one for me. I have been sharing all this content for free for almost 2 years. Your like and subscription will really help this channel to grow and to keep me going. Also, if you would like to further support the channel, do consider buying me a coffee via my coffee page. Alright, back to business. In terms of downside, the two immediate support levels for Apple are 176 and 173. To be honest, even if they get breached, I won't be too concerned. Bulls should only be concerned a little if we break below the recent low of 167.6. That is your cue or signal that Apple is turning bearish. Right below 167.6, we have the all-important 200 moving average at around 166.8. If we close below this and close below that long-term downtrend line, it means we have a sell-off in Apple and likely the tech industry or even the broader market as well. So pay attention to this level or area. Moving over to Tesla's chart, Tesla looks decent as well since it tested that critical 61.8 Fibonacci retracement level. Similar to Apple, it is also creating higher lows over the last 1 week or so. Right now, we are back at some key levels again, namely 255, the downtrend line, and the 23.6 Fibonacci level at around 263. As of last Friday, we have cleared the first two levels, so we are now left with the final resistance level of 263 before Tesla can fly towards 280. Because these three levels are quite near to each other and that Tesla is so volatile, it could just break and reclaim these three levels anytime this week. So for clearer direction, we need Tesla to close above them convincingly for the upside or break below decisively for the downside. Otherwise, as long as Tesla is floating around this range of about 250 to 263, I would call it a consolidation movement after a short-term bullish momentum. For the downside, pay attention to the 50% Fibonacci level because it coincides with the 100 moving average at around 246. If this level breaks, then bulls should stay alert. The all-important support level once again sits at 238. Only when that breaks, then I think bulls should be concerned. Anything above 238 and above 246, I would say Tesla is consolidating and slightly bullish. And do you know what option trading strategy is good for this type of movement? I hope you know. I mean, you should know if you have been following me. Moving over to Google's technical analysis, if you had followed my previous videos, you would know that Google has been consolidating in a range from 127 to 139. And if you know how to trade the stock that is moving sideways or so-called range bound, you would have profited quite a fair bit. More on that later in the options trading segment. Anyway, in terms of price section, Google is looking bullish because it was making higher lows as it moved up over the last 9 trading days. Other bullish signals are, firstly, it bounced off the 50% Fibonacci level, which coincides with the bottom of the range that I mentioned earlier, which is 127. Since then, it has also reclaimed an important level, which is the 50 moving average, which now sits at 132. The third bullish signal is that it has also reclaimed the next Fibonacci level at around 134. Honestly, don't you love technical analysis? Again, if you have been following me, you will probably have looked up for 127 support level for a potential bounce, aka the bottom of the consolidation zone. And when it bounced, it was sort of a signal to go long or bullish. Again, if my TA has benefited you, please help to tap the like button. Alright, before bulls get all too excited, let's check out the potential downside. Come this week, Google may want to test the recent high of 139. If that breaks, then it's good news for the bulls, because that's called a breakout from its consolidation area. But if it gets rejected, then watch out for the various levels that I have mentioned earlier, namely 134 and 127. Because if Google wants to continue to consolidate, it may slide down from the current price to 127 once more. Again, 127 is an important support level. If it gets breached, this means Google is breaking down from its consolidation zone, and we will likely start filling the gap between 123 to 126. Alright, moving over to the options trading segment. I have 3 trades to share this week. But before that, if you have been following my videos, you will know that my recent option trading plan was to sell cash secure put options in September and try to profit from the potential recovery of the market in October or November. You will also know that I did exactly what I shared with the viewers. Therefore, here's a quick update on the 5 cash secure put options that I have sold in September, and they are all green now except for Bank of America. But the amount for Bank of America is relatively small compared to the other trades. And if you have benefited from my videos or option trading plan, please help me smash that like and subscribe buttons if you have not. Okay, the first trade that I would like to share this week is this Tesla cash secured put that expired last Friday, 6 October. The strike price was 210, a strike price that has served me quite well over the last few months. I think I had about 3 put contracts with this strike price that expired worthless and got me about $700 in premium. Anyway, this contract was sold on 30th August, and as you can see, Tesla staged a rally after I opened the trade. Came back down a little, but did not go close to my strike price at all. And then the contract expired worthless, so I got to keep the full premium of $250. The second trade to share is this Google cash secure put that I forgot to cover in my last video. Basically, the strike price was 118 and expiration date was on 29 September, and this contract was sold on 25th August. Once again, as you can see from the chart, since I sold this put contract, Google has been range bound between 127 to 139. It did not even come close to my strike price of 118. As a result, the put contract expired worthless and I got to keep the full premium. And if you could recall, I have shared countless times that range bound or sideways movement is good for option sellers. The longer Google stays within this range of 127 to 139, the happier I am as I can continue to sell put options outside of this range to milk as much premium as I can. Not financial advice, okay? This then brings me to the latest cash secure put that I opened last week, which I had a live recording to show you. But before that, let me share the rationale behind my trade for your reference. So a cash secure put was sold on 5th October Thursday with a strike price of 120, expiring on 10 November. The reasons why I sold this were quite simple because I saw a really beautiful setup which I have sort of covered earlier in the technical analysis segment. Anyway, as you can see on the chart, this row of candlesticks line up so nicely one after another, creating higher lows in the process. This is a very textbook bullish price action. Not just that, can you see this Ichimoku cloud? The candlesticks are bouncing off it so neatly and nicely as well. And these are bullish signals. To add on, at that point, MACD was about to have a bullish cross, which it later did on Friday, and we had a solid big fat green candle. Okay, I know I am revealing the premium that I received for this trade, which may be tempting for viewers to quickly follow my trade on Monday when the market opens. Once again, I would like to stress that this is not a financial advice, and please do not follow my trade blindly. The market could reverse anytime, and I could just take profits anytime as well, which you will not be updated until my videos are released on the weekend. Alright, here you go, the recording of my live option trade. So last Thursday, Google was falling despite its recent bullish momentum, and I saw the opportunity, so I went to the option page. Select the date that I want, which is 10 November. Look for my desired strike price, which in this case is 120. And I'm okay with the premium of $1.37. Then I enter my password. And I click on continue, confirm, order submitted, ordered filled. As usual, sharing some of my thoughts to wrap up the video. So last Friday, I think a lot of investors were stunned when they saw the September's job report. The market plunged quite immediately when the report was out during pre-market. And later on in the day, or night if you are in Asia, everyone was left stunned again when the market staged a massive reversal. Personally, I think this kind of reversal serves as a reminder for a few things. First of all, pre-market has very low liquidity and therefore movements can be huge at times. Also, pre-market should not be used as an indicator on how the market will move during normal trading hours. I am quite sure there were traders who got their 0 DTE put options wiped out if they had bought it when the market opened. The second reminder is that the market can move on any news they want and can spin the news to fit their narrative. If the market has plunged on Friday, the headlines would have been on strong labour market, more interest rate high, oil prices are high, rising treasury yields, blah blah blah. But since the market had rallied instead, so the news has changed to slower wage growth, potential pause in rate hike, oil prices and treasury yields, though still high, they are retreating. Can you see how news can be manipulated to suit the institutions? To be honest, at the end of the day, when it comes to short-term movements in the market such as intradays or a few days or even a few weeks, it is the big players' game. It is not our retail investors or traders' game. So what can we do? Can't speak for all, so I can only speak for myself as both short-term trader and long-term investors. Okay, when I want to trade short-term, I follow the trend. For example, if the big players want to bring the market up, I don't care about the negative news such as hotter job report, rising oil prices, etc. I ride with their uptrend. Likewise, I will do the same thing and ride the downtrend if the big guns decide to sell. The only challenge here is that it's easier said than done. That is why a lot of retail traders get fooled by short-term market movements. To counter this, first, brush up your technical analysis skills. I mean, you can check out my videos. Second, give yourself more time. To be frank with the viewers, I know I don't have the skills to do day trade or string trade, so I give myself more time when it comes to options trading. And I'm talking about 4 to 6 weeks time frame, not those few days or 1 to 2 weeks kind. So far, this has worked for me pretty well as I have been collecting monthly passive income from trading options. The amount may not be huge, but I guess high risk, high returns, and lower risk, therefore lower returns, which I am okay with it. As for long-term investors, your horizon should be 5, 10, 20 years. Therefore, intraday reversal or short-term sell-off should not concern you too much. In fact, weakness in the market should be something that make you feel excited because you can buy stocks at discounted prices. Just to share, the amount of cash that I have deployed in the stock market in August and September is more than what I have done for the first 7 months of this year. As you can see from the image on the right, the fear and greed index has been floating in the extreme fear zone. Remember the old saying, be greedy when others are fearful. Yeah, that was me in the last 2 months. Meanwhile, as I am waiting to pick up more shares, I have also parked my money in the money market funds, which are generating good yields in this high interest rate environment. Personally, I really think this year is an interesting year where our cash can bring in decent returns, while at the same time we get to pick up discounted shares in a bull market. Bad news, negative sentiment, what are they? Things are looking not too bad to me for now. What are your thoughts of the current market situation? I would love to exchange some views with fellow viewers. So please comment down below to let me know your thoughts. Alright, if you like my free content, remember to like and subscribe before you exit this video, okay? Thank you.